Joining us now is KKR's Pete Stavros, who's really known across the industry for expanding equity ownership for employees. Across portfolio companies at KKR, I know you brought in other private equity firms to do this as well. One thing I wonder about is with the recent crash in stock values, do employees want equity? Is this something that they still believe can help them expand wealth in the private markets as firms like KKR sell their firms?
Well, it could be a better time for employees to get access to ownership now that values have corrected somewhat. And we wouldn't ask the same things about CEOs, right? We wouldn't say, oh, values are down, CEOs don't want stock now. And I think we need to change the mindset so that workers get the same access to wealth creation opportunities that senior executives do. And it just so happens that our experience shows when you do that, you can deliver great outcomes for workers, but also better outcomes for shareholders and for companies. It's one of these hard to find win-wins where everyone really can be better off.
Something so interesting about this also is when you put out this release about selling Minnesota rubber and plastics, for example, you said that wages also increased during the time of the ownership, about 6%. How much on top of that does equity ownership really add? From what I understand, this could be as much as a year's paycheck, for example, in an entire equity check.
So one of our core principles is this cannot be a trade for wages and benefits or a 401k match or wage increases. So as you mentioned, at this company, wages increased 6% a year throughout our hold period. And what it can mean at the end is, so in this example, an average worker in a factory earned 100% of their income through stock. So for a $50,000 factory income for a factory workers, let's say it's $50,000 a year in Minnesota, this was a $50,000 payout on average. Our more tenured employees got $100,000. So it's enough to really matter and set people up for a path towards retirement. And look, when things really go well, when we sold CHI overhead doors last month, it was a 10x deal for our investors, so you got to have that context. But factory workers and truck drivers, some of them made $800,000 in the sale of the company. So I mean, this can be really significant wealth creation.
Meanwhile, we look at an economy that is apparently slowing. Whether or not you think it's technically a recession or eventually a recession is by the by. But are you starting to see some of your portfolio companies having to tighten the pools of their labor? Or are they more fiercely looking for that? How are they keeping their talent engaged in this period of a slowdown? Yeah,
we're not seeing a lot yet in the portfolio. Everyone's nervous. So as you see in the numbers, consumer confidence is down, small business confidence is down, the PMI for new orders broke 50, so everyone's nervous, but in the portfolio, we don't see it yet. And the labor shortage is a big problem for everyone. So how are you going to keep employees engaged and less likely to quit? And one of the tools, and this is just the foundation, but one of the tools is ownership. And what we've found is if you pair that with information sharing, so people can see what's the business plan, where are we headed, how are the financials doing, what can I as an employee really do to help move the needle. It's about making people feel included, trusted, respected, and acknowledged. People are less likely to quit. You know, one of the public companies I'm sure you all follow, Ingersoll Rand, which we used to own, 16,000 employees became owners in the business. They generated wealth for themselves of $500 million. Now, this took 9 years. It doesn't happen overnight. But the quit rate there went from 20%, so 1 in 5 were walking out the door every year. And at the end, 9 years later, it was 2 in 100 walking out the door. That's a big deal. Think about all the money you save in recruiting, retraining people. Think about how unproductive people are in the 6 months before they walk out the door. So the benefits to the company of this type of a program we think are massive.
Sort of big picture, as you think about the financials, the environment that we're in, are we still looking at a big disconnect in valuations between sort of the public markets and the private markets? Are we getting closer to seeing more of an agreement on what these companies are worth?
Not yet. So as you know, in private markets, it's always stickier, particularly on the way down. No one's going to sell the entirety of their company until they're sure this is the new normal for values. So it's going to take time. We're also in a summer slowdown, so there's not a lot going on. So we need more data points and more time to pass to say there's been now a normalization between public and private markets. We're not there yet.
Is the direction of travel towards the downside or the upside at this point? I know the public portfolio or the private equity portfolio had lost about 7% in the second quarter. So are there headwinds or tailwinds ahead for you?
So our portfolio was down 7%. The broader market indices were down 16%. We are more focused on performance since inception. So since inception, our Americas funds are up over 30% per year. That's really the focus versus quarter to quarter. But to your question on where we headed from here, if you look at EBITDA multiples, which is our key measure of valuation, the S&P is now at 11 times forward EBITDA earnings. and that's down from a peak of 15. So the multiples come down. The big question is what's going to happen to what you're applying the multiple to? Where are earnings going? And consensus is next year we're going to see 10% earnings growth. That seems optimistic to us. When you look at confidence, inflation, what's going on in Europe, don't forget 40% of the S&P's revenues outside the US. We've got now a strong dollar at parity to the euro. There's a lot of earnings headwinds. So I would say the multiples feel mostly there. The earnings probably were too optimistic. That could indicate some more downside in values.